Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark talks about new lows for gold and other metals. Real estate expert Robert Campbell expects American real estate will hold its value for now. And AddictedToProfits.com editor David Skarica comments on the plunge in retailer shares. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Pleasure to be with you, Jim.
Not a pleasant time for commodities in the past week.
No, this has been an extension of downtrends, and we're starting to see some of the acceleration. We've talked the last few weeks here about how that $43, $43.50 level on the crude oil had been a support, and that if that was taken out, we would be probably on our way into the 30s. Well, by the middle of this week, that's happened, and we finished off the week around 40.5. That has taken all of the energy side of the Canadian equity market down with it, and we've seen other commodities such as copper now sitting at lowest levels since 2009. You've got some of the, on the precious metal side, you've got platinum and palladium coming under pressure. We've got interest rates having risen for a couple of weeks, took a little bit of a pause this week. But overall, it's been a heavy stretch. Starting to see some excesses. We've had gold market was down for 9 consecutive days. Silver has been down for 12 consecutive days. That type of action is what you would expect to see or classify as excessive and maybe climactic. But when we look back on the history of this, in reality, what we're probably looking at is maybe a 1 to 2 week bounce, and then probably a retest of the lows, if not considerably lower.
Now, these bounces, they keep happening since August 24th, Black Monday, but every bounce, it seems, is a little less high or lower than the one that was before.
Yeah, in the commodity side in particular, that's been what we've been seeing over and over again. And, we did have way too much enthusiasm on that first rally out of the bottom. We saw the commitment of traders numbers in gold and silver were just way up too high. The sentiment indicators got up to extremes, but really prices were not as strong as the enthusiasm. So as soon as you start to then see signs of a turn and the momentum being lost, then these things tend to feed on themselves. So, as I say, probably a little oversold right now. We're coming into a seasonal window where you would expect to see tax loss selling increase, and we'll talk in December about potential turn of the year trade that we take every year, and I'm quite looking forward to that one this year because we've had a number of items beaten down here. If we just take a second and look at the stock market, independent of the Canadian market, which is so much resource-oriented and coming out of the pressure, if we take a look down at the U.S. market, a very good recovery high into the targeted resistance levels for the Dow and the S&P 10 days ago. They lost momentum, starting to roll. And last week we talked about how the 50-day averages on most of these indices would be a pretty good target. And as of Friday's close, we're getting within very, very close proximity. So I wouldn't be at all surprised that the early part of next week might see an interim low, and we'll see what kind of bounce happens out of here.
Have the high techs like Google and Amazon kept the numbers on the big markets artificially high?
Oh, without a doubt, those big market cap items do have an influence. If you take a look at the unweighted indices of the S&P and the New York Stock Exchange, you can see that the recovery off the August low has really been quite a bit poorer than the indices would make it look when you take a look at that capitalization weight side of the index. And so it's just internally, it's like we saw last spring, where we were progressively making marginally higher highs, but you weren't doing it with the advanced decline line, and you weren't doing it with the unweighteds. So when you do start to see weakness, it feeds on itself pretty quickly in terms of the broad market. And when you start to lose momentum, think back to the spring when the biotechs and the healthcares were really leading on the upside. When they rolled over in the summer, then that became the last straw in terms of holding the marketplace up. And what you're seeing right now is things such as Google and Amazon. They reversed here this week. Maybe not enough to say it's the end of the move, but clearly at the tail end of the week, they had lost their upside momentum as well.
Ross, thanks a lot for chatting with us.
Always a pleasure, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. If you have any questions for Ross, you can email him at ross.clark@cibc.ca. Coming up next, real estate expert Robert Campbell on This Week in Money.
Always consult your investment professional before making any investment decision.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is U.S. real estate expert Robert Campbell. He's speaking to us from San Diego. He's the founder of the Campbell Real Estate Timing Letter, as well as author of the book Timing the Real Estate Market. Bob, welcome back to This Week in Money.
Thank you very, very much. So happy to be back, Jim.
The latest issue of the Campbell Real Estate Timing Letter is hot off the press. What is your latest issue, and how can people find out more about it? And first of all, what's the headline on it?
Well, the headline is, I'm working from memory right now, is the trend in U.S. housing prices is still up, and it's pushing prices higher. So there's no mistake about it. Housing prices are going up, and I've learned in the past to rely on those numbers, even though there seems to be a lot of bears that have been predicting the bust, every year for the past 5 years during this housing bull market. But nevertheless, even though I have my questions too as to how long this thing can keep going, it's still going. And there's, as long as the train's moving down the tracks in the direction we want it to go, Jim, there's no reason to jump off. So I'm still advising all of my followers, to stay aboard.
And if you're interested in getting the newsletter, how can you do it?
You can go to realestatetiming.com, just like it sounds, no dots or dashes, realestatetiming.com, and you can go to Real Estate Timing Letter, and it shows you how you can either subscribe for a year or order a current issue.
In Canada, we've had so many warnings now that real estate here is 30 to 40% overpriced, especially in the Vancouver and Toronto markets. Have you done any research on that?
I haven't. I've been, we've been talking about the Canadian housing market, for 5 or 10 years now. And it's resisted it took leveled off during the housing bust in the United States, but it's never gone down. So that, the times, it's still not time there. And as I've advised all of the Canadian real estate people, just keep watching the trends, you guys, because markets will and do change. Nothing goes up forever. And if you're 30 to 40% undervalued, those housing prices are going to revert back to the norm at some point in time. And you're probably not going to want to be a participant, in that event. And you're probably going to want to sell before the before prices start going down, and then, to lock in your profits. But the time is coming, but I've been amazed as anybody else that the prices keep going up.
Well, I just saw a report from England saying they expect real estate prices there to go up 25% in the next 5 years.
Wow. I was just in England a couple of years ago, and I saw more construction cranes in England than I've ever seen in any place in my life, Jim. So I know England, and especially London. I don't know about, that England, the housing prices going up there per se. I know their housing market has still been strong. However, if they, over the course of the next 5 years, if you were to predict that housing prices are going to go up 25%, over the next 5 years in England, I would take the under bet on that. Because I don't think the world's going to stay like it is for 5 years.
Right, and of course the migration crisis all over the place. Canada plans to bring 25,000 Syrian refugees into the country before the new year. Is that going to affect real estate or not?
Absolutely. What I think it's going to affect, 25,000, what's the population of Canada?
About 33 million.
Okay, so 25,000 isn't a big deal. But nevertheless.
How about the bond market and mortgage rates?
The bond market's still hanging in there. We're clearly in a bubble. We've brought interest rates down to, I think it's 3,000-year lows. So that's not going to last forever. You know that. And, however, that, since Draghi's talking about, QE, another round of QE, and even, Janet Yellen, the Fed chairperson, she has said that, no policy solutions are off the table, and that includes negative interest rates. Hey, I don't put anything by these maniacs, Jim. I don't put anything by them. That's where they may take them. And is it going to work? Nope, it's not going to work at all. Just like QE didn't work, in any way to re-stimulate or rehabilitate, the Main Street economy. All it did was jack up asset prices, the stock market in particular, and also, U.S. housing prices. And, U.S. housing prices and the stock market, that doesn't generate by itself any economic activity whatsoever. Even though it's supposed to have some wealth effect, it doesn't create any new products. All it does is keeps the wheels up from coming off the car.
If you have negative interest rates, of course, that means the bank charges you money for having money in their bank. If I took out a mortgage, would they pay me to take that money out?
No, it'll never get that bad. But that's a great thought. No. And to show you these negative interest rates, how crazy it is, that there's some short-term, sovereign bonds in even Italy. And Italy is one of the most broke countries in the world. Negative interest rates on some short-term, sovereign debt, Jim. Can you believe that? Italy.
Well, who would take out a bond if it cost you money?
You know why people are, and Germany, of course, has negative rates. The best answer I've seen for negative rates, and especially they're deeply negative in Europe, in Germany and in Switzerland, is what they think is that the euro's going to go bust, and that, like, Germany's going to go back to the Deutschmark. The Swiss use the euro, or do they have, or they still use the franc?
Yes, they use the franc.
They're back to the franc. Okay, so they're safe using that. But what they're counting on, why they're doing this, is they're just counting on the euro going bust. Breaking up the euro. And what place do they want their money? They want to be in Germany, because the Deutschmark is going to be the strongest currency if they all have to go back to their old native currencies. That's the best explanation I can see.
Well, that's why Britain held on to the pound.
Yep.
They didn't trust the euro.
It's so interesting what's happening in the world right now. The underlying dissension that's going on. England's going to vote, even though they still use the pound. They're voting to get out of the euro, out of the European Common Committee, whatever they call it.
Yeah, the Commonwealth, European Commonwealth.
European Commonwealth. They're voting just to get out of it. And I think it's going to pass.
Well, under European rules, technically they're not allowed to sell pints of beer or have double-decker buses.
Right.
And so,
and they're saying, we don't need them, and let's just get away from them and rule ourselves. And I think that's the way a lot of countries are ultimately going to go. If the euro survives, I'll be really surprised. I'll be surprised. I think ultimately it's in a course with disaster, and it's going to break up just because of the different cultures and the fact that Brussels has become so authoritarianism. You know, who was it? It was Portugal. Portugal was going to put up a vote whether they should stay in the euro or leave the euro, and Brussels came down and said, you can't have that vote because it's not in your best interest. In other words, Brussels is just telling everybody what they do, what they should do, whether they want to do it or not. They don't have control over their destiny anymore. And so how this turns out, I just don't think it's going to turn out well.
So, Bob, Canadians have bought real estate in the U.S. How secure is that real estate, or should they, say, sell it and run away?
Well, I think they're still secure right now because the trend is up. Prices are still trending higher. However, the biggest mistake you can make in real estate is that you buy a piece of real estate at or near the market cycle peak. And I would say, using, baseball parlance, we're probably, I would say, in the 7th or 8th inning of this real estate upturn. We've been long now. My timing system had me long, U.S. real estate here in Southern California since, mid-2000 and 2010. So we're past that. We've been long over 5 straight years. Real estate cycles, that's a pretty good uptrend. So if it lasts another year, that's going to be pretty normal. But, what I'm, even more worried about is what's going to happen to the global economies and what's going on. I think those trends are the ones that are scaring me the most, because the whole world is going into deflation right now. And it's, and that what we got to worry about is with all this debt out there, with deflation, that makes that debt even more unpayable. And so they can't stand for the deflation, so they're going to have to crank up the money supply somehow, so one way or another, either through increased credit or, just the printing press, and get prices, off of zero and start moving up. But I'm still not afraid of real estate yet. I'd be okay. But it's one of those things that if you're buying in right now, you're pretty close to being late to the party. So when this thing turns down, and equally would I expect, U.S. housing prices to fall, during the next downturn, I expect them to fall anywhere between 20 and 30%. So it's not going to be a nice, it's going to be another scary sell-off. And in California, you can add 10% to those numbers, because California is the most volatile housing market in the country.
In the late 80s, the Japanese were buying a lot of real estate in the U.S. and Canada. Now the Chinese are doing the same thing. Are there similarities between the late 80s and now?
Oh, absolutely. And especially in one California city, San Francisco. The housing prices in San Francisco have doubled in the last 3 years. Now, that's totally unsustainable. Totally. So, compounding that number, so housing prices are going up, let's say at, something like 25% a year. That's totally unsustainable. And that market's going to crash. I know that San Francisco is probably a 3 standard deviation event, and even 2 standard deviation events always result in crashes. So there's little doubt in my mind that the San Francisco housing market is going to come crashing down.
If you've just joined us, we're speaking to U.S. real estate expert Robert Campbell. Are there markets in the world that seem to be crash-proof? And I'm citing Manhattan, London, and somebody has said recently Vancouver's the same way, because they're building, spec millionaire property in the richest community in Canada, West Vancouver, and it's selling. So they're saying you're kind of bubble-proof.
I wouldn't. If I had to say what real estate in the world is the safest, it would have to be in the United States, because I think we're probably the last Ponzi scheme that's gonna fail. And even it's gonna fail. But for example, that China, money's running out of China right now. Why? Because they don't trust the economy. They're in a debt bubble, and they're trying to bring the money into a place that's more safe, whether where they can protect the purchasing power of it. And where are they bringing it? To a large degree, they're bringing it to United States, to high-priced markets like San Francisco, like Manhattan. I don't know about London. I know London has the most expensive real estate in the world. Number 2 is Manhattan, from what I understand. So, but I'm a lot more comfortable. If it was my money, I'd be a lot more comfortable keeping it in the United States, at least for now, because that, like I say, the dollar's strong right now, and I think the last country to break is going to be the U.S. But it's going to break too. The housing market in the United States is going to come crashing down too at some point in time. So that I don't think there's one asset class, including real estate, that is immune from a very, very significant downturn at this point.
Is the U.S. experiencing inflation, deflation, or a combination of both?
Well, it's always a combination of both. It's always a combination of both, because some things are inflating, like real estate's going up, the stock market's going up. That's certainly asset inflation. However, incomes are going down. But prices in general, I wouldn't call it deflation. I wouldn't call it deflation, because the cost of living is going up, especially for the essential things here. When you talk about energy, energy prices have gone down a little, but they've been more than offset by the increase in healthcare costs, Jim. More than offset by that, because, I think it was Obamacare, that, our Obamacare healthcare system, that I think the government came out and said, yeah, the average price increase is going to be 7.5% this year. I read other stories that people looked at it more objectively, and they said, that's BS. It's more in the 15 to 20% range, which I believe, because I hear stories about people, what their premiums are going up to. But it's just healthcare costs are out of control. So between healthcare costs, and housing costs, rental costs are never been higher. The gap between a lot of people in the United States, something like, 30 or 30% or something of all renters in the United States are spending 50% of their income on a monthly rental payment. How bad is that? From housing, healthcare, and certainly energy costs aren't going down. My electricity bill's not going down. My water bill here in California certainly isn't going down. In fact, it's going to go up about 15% next year. I mean, maybe it's because of the drought, but who knows? And I haven't bought a PC. I don't know what's going down in price. It doesn't seem like anything's going down in price. Some things may be kind of leveled off. Everything I buy seems to be going up in price.
We keep hearing don't bet against the U.S. dollar. Is the U.S. dollar likely to remain the go-to fiat currency?
For a while. It is. Because, like I say, it's the last Ponzi scheme. It's the last Ponzi scheme that's going to break. And so everybody's piling into the U.S. dollar right now, think it's the safest way to protect their money. However, coming down the line, as we keep increasing our national debt and the unfunded liabilities keep building up, at some point in time, there is going to be a rush out of all fiat currencies, and especially sovereign debt that is funded in these fiat currencies, because people know that especially like the U.S. dollar, there's something like $8 trillion, outside the shores of the United States. Well, these guys know that there's no way in hell that the U.S. government or that can pay for can make these payments in real dollars. They're not going to increase taxes in the United States, and so that these can be paid back in real dollars. They're either going to default on them or they're going to inflate. And this is a real interesting story, interesting conversation that I had with Tom Allen when he called last, setting up this telephone conversation that we were talking about. What do you think is going to happen? We keep hearing about deflation. Oh, we're going to have this massive deflation all over the world because of the debts and the unfunded social promises that can't be paid. And all of a sudden, I'm a great one to read economic history. And if you look back 50 years, Jim, 50 years, and you look, how many deflations have we had compared to, let's say, hyperinflations? And I don't know of any deflations in the last 50 years. However, in the course of the world, there's been at least 50 hyperinflations. So what I think is going to happen, I don't think there's going to be a default. I think that all this debt is we're just going to devalue the dollar, which is the same as inflating the debt away, and that's how we're going to pay for it. We're going to pay for it. Yeah, everybody's going to get paid everything they're owed, but it's going to be in Zimbabwe dollars. And of course, that what that does is that takes interest rates, right off the graph up to the moon, and looking at asset prices like real estate, how dependent are real estate prices on affordable financing? What, 90%? So all of a sudden now there's going to be no financing, and that's where I think that eventually this is going to end in very, very high inflation, and this is what's going to take down real estate and all the other asset prices with it, because high inflation is devastating to the economy, Jim. Devastating.
Are you bullish or bearish on gold and silver?
I am very, very bullish on gold. I think gold within the next 5 to 10 years is going to become the premier wealth asset for the reasons I just talked about as to whether we're going to inflate, whether there's going to be inflation or deflation. Even though I think gold works both ways. If you study what happened during the U.S., the 1930s in the U.S. during that deflationary period. That's the last deflation we've had. It's 85 years ago. Gold was revalued from $20 to $35. If you go to Germany, that 1921 to 1923, the Weimar Republic, the gold went right up with the rate of inflation, protecting the purchase price of all those dollars. And you even go to Japan. You say, okay, since the credit bubble burst in Japan in 1990, what's happened to the Japanese stock market? Down 50%. What's happened to real estate prices? Down 50%. What's happened to gold prices? They're even. They held their own. See, for reasons like that, I think gold should be a lot bigger part of most people's portfolio than it really than I know it is.
With the aging baby boomers, how endangered are our pensions?
Oh, absolutely. That's another problem, that we have. Right now that I'm a baby boomer, I'm 68 years old, that there's, for every person that's retiring right today, there is a total of $40,000 a year that is spent on Social Security, Medicare, and Medicaid. And so there's 78 million of us, they say, and what that means is these social programs that are propping up the U.S. economy, social/welfare/transfer problems that are holding up the U.S. economy. We're something like $200 trillion in the hole on making these payments when you use honest accounting to look at it. So either that you have to default on those obligations, and I just read a major study on that, to make Social Security, Medicare, Medicaid, and the government pensions whole, you got to do one of two things. You got to permanently raise income taxes today by 58%, or you have to permanently reduce all the benefits people are receiving by 58%. I'm not talking short term. I'm talking now going forward forever. Well, either of those, options is devastating, right? Absolutely devastating. So what I think is going to happen is I think that they're just going to, what the politicians are going to do, nobody likes to default on an obligation. They're just going to inflate, that create massive inflation, and all those obligations are going to be paid dollar for dollar, even if they pay only if those dollars will only buy you a fraction of what they could before. And that's what I think is going to happen. So do I think pensions are in trouble? Absolutely, I think pensions are in trouble. The U.S. pension system in the United States is $18 trillion industry, and by everything I've read, that it is underfunded by 35%, Jim. 35% underfunded. And so, you can't make something out of nothing, so some way that 35% gap is going to get closed. And I think it's going to get closed with highly inflated dollars.
Do you see any trends forming in the race for the White House?
Trends all I can hope that is a non-politician gets elected. That's all I can hope for. I mean, I am not a Republican. I'm not a Democrat. I hate both of them. To me, there's no difference whatsoever. It's whether the Corleones or the Capones are in office. And I just hope it's somebody like frankly, I'm rooting for Donald Trump. You know, not that he doesn't have any faults, but if you look at if you draw a line and do the old Ben Franklin close and look at the pluses versus the minuses, his pluses outweigh his minuses by about 5-1, and I can't say that about anybody else. So I'm voting for Trump, the non-politician. And I know how he knows how to deal with people with debt, and that's our biggest problem. I mean, he's still not going to avoid the pain. No, the pain's not going to get avoided, Jim. No way. But I'd rather have him in charge than anybody else.
Robert, thanks a lot for chatting with us.
Oh, you're welcome. I really enjoyed it.
My guest has been Robert Campbell, founder of the Campbell Real Estate Timing Letter. His website, realestatetiming.com. Coming up next, Dave Skarica, AddictedToProfits.net editor, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Dave Skarica, AddictedToProfits.net editor. Welcome to This Week in Money, Dave.
Thanks for having me.
You're very concerned about markets and debt right now. Maybe explain that.
Well, basically, about the middle of last year, early last year, I started getting very bearish on the U.S. equity market. And this was just the macro kind of picture. In terms of, you look at market cap to GDP or the CAPE ratio, which is the 10-year average PD ratio of the S&P, or something called the Q ratio, which is that's kind of a complicated ratio, but it's still a ratio to measure valuation. And what has essentially occurred is all of these valuation metrics are showing near record, valuations in the U.S. stock market. Actually, a lot of them, other than, say, the 2000 tech bubble, have never been this high before. So I just became worried about that. And starting last year, I looked for bubble stocks. I started shorting them. And, it worked with like mixed results. But this summer, regardless of what the market rallied or did, say, late September to early November, I can tell you the market really changed. Companies began to decline in bad news. A lot of the overhyped, overvalued sectors have begun to come off. A lot of the sectors which were ridiculously overvalued for what they are, like mid to lower end restaurants, these types of things which have gone straight up for 2-3 years, they all begin to sell off hard. Seen the retail sector getting decimated, and a lot of these kind of second tier names that I'm sure are like shorts are doing fantastic. I do a lot of put option trading too, and some of my put options are up 300, 400, 500, even 1,000%. And I'm really noticing that the makeup of the market has changed. That people are looking at the Nasdaq being still near 5,000, or the S&P near 2,000, 2,100. But what I'm trying to tell them is no. This has changed. We've got the Googles and the Amazons and all of these big name, high flying tech stocks kind of holding up the market average. By the way, that also happened in October 2007. All of those companies gapped up in earnings in October 2007. Just like they did this past October, and October 2007 was the top of the market. But I'm seeing all kinds of stocks breaking down, moving down, and one thing that's changing is some of the big leadership stocks outside of those tech names I gave you, like Nike, for example, would have been one. They've really started to break in the last week or two or so. So I think this is really, really interesting, and a sign that we're still in a bear market. Because what happens in bear market, same thing happened in 1999, same thing happened in 2007, is the rally gets thinner and thinner, there's fewer stocks moving the market averages higher, and most stocks are not acting well. So we started really seeing that over the first half of this year, and now on top of that, seeing some of the big leadership stocks and the last stocks that held up, they're beginning to crack. And I think this is really, really important. And as a disclosure, I a couple days ago, earlier this week, say roughly November the 10th, I put a short on Nike. So that's just a disclosure that I'm short Nike.
Now, we've seen American Apparel has gone under. The retail clothing business is very, very tight right now, isn't it?
Yeah, like Nordstrom just had disastrous earnings. Macy's, which had really held up really well for a retailer until about 6 months ago, it just gapped down about 20% the other day, and that's on top of already being down 20 or 30% from its high. And, like Macy's is 40% below its 52-week high. So yeah, I think we're really seeing declining, we're seeing pressures in that industry. If you know your size and what you like, you can order jeans on Amazon, right? So, so I just think we're seeing kind of the end of that. And another thing too, it's retail names and restaurant names, which is really interesting. Right now, about a year ago, is when oil had its smackdown into the 40s, and 50s in November, December of last year. So I think they had an initial push in retail sales from, I'm saving $40 a week on my gas. Maybe I'll go buy a pair of jeans. Maybe I'll go to Domino's and buy a pizza, all this sort of thing. But I think even if oil prices stay low, that initial consumer surge from them is over. Now people are getting more accustomed to the low oil prices, and maybe they're going to save the money now, then rather than do a little spending spree. And I think that that's also affecting the retail stocks, because they all have this push up on like a short-term kind of oil wealth effect, lower oil wealth effect. And I think also they were also going after anticipation that they would get more and more sales from these low oil prices. And actually, what you're seeing is, because of Obamacare increasing the cost of healthcare and all this sort of thing, you're actually seeing a lot of that savings from oil going towards having to, pay for stuff like that.
That's a factor that Canadians don't really worry about, because we have government-sponsored health care, although in some provinces like BC, we still do pay medical premiums, but I think $130 a month would be considered pretty cheap to an American couple.
Yeah, being a non-resident now in Canada and living offshore for 10 years, I have to pay private insurance, and you can get a quality private insurance plan offshore for $100 to $200 a month, which is no way to do that in the United States. Actually, a lot of these offshore insurers, unless it's an emergency, they won't cover anything in the States. Like if I wanted to get something cosmetically done, or maybe something like unfortunately, even though I'm not that old, I have a bad right knee, and if I wanted to get my knee scoped or surgery or something like that, I'd probably have to go to a jurisdiction like the UK or even someplace in Asia or the whatnot to get it done, because the U.S. has such high premiums and costs due to all the malpractice suits and all that sort of stuff kind of built into the system. So yeah. So I think we're not really used to that. But anyhow, the basic moral of the story is it's not just those sectors, that we're now seeing the majority of stocks actually acting very, very poorly. Like the S&P is really only about 5% from its highs, yet only 50% of the S&P companies are above the 200-day moving average. So that's a real sign of internal weakness in the market. And my publication, we're really taking advantage of, you have to be very selective, you have to do a lot of research, you have to stock pick, of really finding these companies that I think can really decline badly in a potential bear market. Or they can just decline badly on their own, just because they're overvalued and they're, for lack of a better term, they're crap companies.
You were speaking to David Skarica, editor of AddictedToProfits.net. David, what can a person do to try to accrue some profit when a market is looking like it's going to tumble?
Oh, sorry, can you repeat that? I just had a bad connection here for a second.
Okay.
Just repeat the question.
Yeah, no, I'll just go from the top. Welcome back to This Week in Money. We're speaking to David Skarica, editor of AddictedToProfits.net. David, when it looks like the major markets are going to take a big tumble, what can a person do to protect themselves if they want to make some money?
Well, obviously what I'm doing is a little more sophisticated. I'm doing something like a guy like Bill Fleckenstein or Jim Chanos, or these professional short sellers would do. And there's only Jim Chanos, for example, is one of the only big short selling hedge funds in all of the United States. You just think of all the trillions of dollars under management. You have one guy who's got maybe $4 to $6 billion under management. He's really the only, there's Citron, there's another one, but really he's the biggest name in terms of short selling. And I think what the average person can do is maybe look at some bear ETFs, maybe some double leveraged ones. They erode. The one I really like, and I have no problem recommending this on a program like this is to hedge, the HDGE. H as in hand, D as in David, D as in Greg, E as in Eric. And this is basically, what I like about this is an actively managed ETF. So they pick the shorts in it, they pick the overvalued companies, they're trying to give you leverage to the downside in the market, and because it's not a 2 or 3 times leveraged one, they're really, really, they're not going to erode. So I would think something like this, if you got a bear market of 30 to 50%, something like this could double or triple in value. And you could just look at it this way. Well, let me put, 10 or 20% of my portfolio into something like this. And if the other 80%, say just make it easy, you have $100,000. That other 80 grand goes to 50 in a bear market. Well, the 20 in this fund might go to 30 or 40, and it cuts into your loss. And if that 80 goes to 120, the market goes up another 50%. Great. That 20 might go to 10, and you're still making money in the end, right? So I think one thing that the average investor does not do enough of, people have a weighting towards being positive, thinking the market's going up, because I think they think the markets are also a reflection of where they live. Canada's booming, the United States is booming, you're nationalistic, you want your country to do well. But I think that hedging is something that I think most average investors kind of have to do. And another idea would be maybe just simply buy the TLT. I know that interest rates have backed up recently, and the Fed might raise 1 or 2 times, but I really think that after the 1 or 2 hikes, it's going to really decimate the markets and the bond markets around the world. There's $9 trillion of debt has been issued in U.S. dollars since 2008. So I think just even 2 interest rates are going to kill a lot of this. A lot of this is emerging market junk-oriented debt as well. So something there might be, after an initial sell-off, there might be a flight into the U.S. bond for 6 to 12 months. So that's also a simple trade that someone can do. If you go look at 2008, the early 2000s, bonds performed very well. And I think loaning the money to the U.S. government 10 years or Italian government 10 years, 1.5%, 2.5%, joke, but it's more of a trade. It's more like you'll get the so-called flight quality trade during a potential bear market.
If negative interest rates become established in North America, what will that do to the economy?
I think at some point, a lot of this becomes pushing on string. And we're seeing, like in Europe, negative interest rates is not causing banks to borrow. It's not causing people to spend. They're probably just put their money under a mattress or move the money to a bank that doesn't have negative interest rates, or move it into Bitcoin or gold or whatever it may be, And I think that we actually have seen a big boom recently in the States in consumer credit, and that's kind of actually more of a late cycle thing. And the consumer credit's not good, by the way. It's subprime auto loans and student loans, so it's nothing really that's going to drive a big economic boom or anything. And probably the student loan market's potential, the next kind of subprime blow up kind of market. But anyhow, what I'm saying is I don't think these things will work after a while, because I think a lot of central banking is and 2007, 2008, people lost confidence in the Fed. They thought that they created that bubble. They were too loose for too long. They couldn't, they totally missed the banking crisis. They totally missed what was going on. And I think now people have confidence in them because they've basically inflated asset prices. The real economy is not much better than it was 5 years ago, but they've inflated asset prices and gave this false sense of security to investors. And then when you finally get another blow up in the asset markets, people lose confidence. And I really think that if you do a next round of QE or negative interest rates, it won't affect the market the way they want it. Like, maybe you can get a 6 or 12-month rally when that happens, but I really think that longer term, it's going to, because again, people lost confidence in 2008, and then when this blows up, people are going to say, well, they caused this bubble. They caused all this money. Corporate debt is twice now what it was in 2008. They caused all these companies to go out, borrow cheap, do stupid acquisitions, and, you can blame these companies for acting in this reckless manner. But this is what cheap money does, So I think that negative interest rates, another round of QE, just won't have the same effect. What I'm expecting, and I was wrong about this, by the way, but, like in 2009, it was right for 2 years and wrong for the last 3 or 4. I would expect the next round of QE to go into real assets, because after corporate debt is doubled in 8 years, it's not going to double again. So it'll be a backup of corporate yields. And people will say, well, they're putting up money again. Where should we go? And they'll be like, you know what? Screwed up the stock market twice in the last 10 years. I think we got to go into hard assets. I think we got to go into gold. We got to go into silver. We got to go, even though there's a glut of, say, iron ore and copper, we got to go into, inflation, as Milton Friedman used to say, is a monetary phenomenon. So it's too much money chasing too few goods. So if they decide to print another $1 or $2 trillion a year, I think despite the fact that there's oversupply or less demand from China, you're going to really see these commodities down. And we are now in a near 4 to 5 year cyclical bear market for commodities, especially gold and precious metals. And that's about as long as I've ever seen in any market for a cyclical bear market. About the only comparison I have is about the 96 to 2000, 2001 bear market in gold and gold equities. And I really can't find another market. Even the Great Depression of 29 to 32 was about a 3-year bear market. I really can't find another bear market that's 4 to 5 years.
David, how can people subscribe to your newsletter?
If they go to addictedtoprofits.net, I have a free publication. I give samples of my work and post podcasts like these to tell you how I think. But every month or two, I usually do some kind of special offer to my newsletter. And I really think it's kind of an investor who's interested in thinking out of the box, thinking of like short selling right now. This is the best I've seen for short selling in years and years. And I really think that my newsletter is unique because I actually started a service associated with my newsletter called the Short Corner, where we actually just short stocks. And I think there's actually no other service like it out there. So just go to addictedtoprofits.net, sign up for my free letter. You can drop me an email, and I can give you some more information. But if you're really interested in maybe playing this to the downside, I think that my letter is going to really hopefully help investors in the next year or two.
David, thanks a lot for being on This Week in Money.
Thank you very much.
My guest has been David Skarica, editor of addictedtoprofits.net. That wraps up our show for this week. Thanks to our guests Ross Clark, Robert Campbell, and David Skarica, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.